Welcome in, folks, and happy Monday to all those that are watching on this glorious Monday. And for people watching in the future, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, happy day to you as well. Got some big subjects to react to here today. First one we got to react to is this that came out this morning. S&P's 500's decade of big gains is over, says Goldman Sachs. Goldman Sachs has a very gloom view of the next decade in the stock market. So I want to get into that. I think it's a subject absolutely worth addressing, kind of give my opinions and perspectives on that one. Then we have some videos to get into, and so I thought, man, right after that kind of gloomy picture, let's get into a Tom Lee. So Tom Lee went on CNBC 4 hours ago, spoke about his opinions on where this market's headed, those sorts of things. Then I want to get into this one. Market remains in decent shape for 2-year birthday of bull market, says Fidelity's gentleman here from 2 hours ago. Then we react to this one. Microsoft takes aim at Salesforce with new autonomous AI agents. I thought that would be an interesting one to react to. And last up is Kramer stopped trading on RH. So yeah, a bunch to get into here today, folks. Appreciate you joining me. I'll ask you to return, smash that thumbs up button. If you want to be subscribed to the channel, you can certainly hit the subscribe button. Today, I'm going to put my Patreon down there as the pinned comment if you're looking to join my Patreon so you can see the stocks I'm buying and selling each week. I also want to let you guys know that the price for anybody that doesn't join over the next few days is about to go up 30%. So if you're interested in joining my Patreon to be able to see the stocks I'm buying and selling each week, get in there ASAP, because it's literally, we're only a few days away from me going up 30% on all prices of new members that join after that point. So just so you guys are aware, if you're interested in that, definitely go ahead and check that out, okay? Pin comment. So S&P 500's decade of big gains is over, Goldman says. The decade of outsized returns for the S&P 500 may be over, Goldman Sachs said in a recent report. The bank forecasts that the index will deliver a nominal annualized return of just 3% over the next decade, significantly lower than 13% annualized seen in the past 10 years. Adjusted for inflation, the real return is expected to be around 1%, ranking the forecast in the 7th percentile of historic 10-year performance since 1930. One key factor behind the pessimistic outlook is high market concentration, with the top 10 stocks now accounting for more than 1/3 of the S&P 500's total market capitalization. Today's extremely high market concentration suggests the S&P 500 equal weight benchmark is likely to outperform the cap-weighted aggregate index during the next decade at an annualized 200 basis point to 800 basis point, Goldman Sachs reports. Ooh, this is very interesting, okay? So I have a few opinions on this, okay? First up, I think there's something very important to understand. Very important to understand about these top companies, these big dog companies. These companies have already shocked us in terms of what they've been able to accomplish, what they've been able to do, right? And when I talk about top companies, I'm talking about the Apples, the Microsofts, the Metas, the Amazons, the Nvidias, these sorts of companies. No one ever thought multi-trillion-dollar market caps was really a realistic possibility. When I first got in the stock market 15 years ago, no one was talking about companies going to $1 trillion market cap. Never mind multi-trillion dollars, that was not a thing. People thought, okay, a 500, when I first got in the market, end of 08 into 09, right? In 2010, as those years went on, people thought, okay, $500 billion market cap, maybe $750 billion. People weren't even thinking about trillion, never mind multi-trillion. And here we are today, we got many companies that are now multi-trillion dollar market cap. So these companies have already way outperformed what people thought, which means they could do that again. They might not, but they could very well do that again, right? Like Meta, where's the top for Meta? We don't know. We've never seen a business model like Meta before, right? Could Meta be a $5 trillion market cap, $10 trillion market cap, $20 trillion market cap someday? It's not out of the realm of possibility. I wouldn't call it a guarantee, but we don't know. Like their business model is actually pretty new. Like, let this sink in for a moment. Meta's business model is still new. It's new. Facebook is not old. Facebook is new. Instagram is not old. Instagram is new. WhatsApp is not old. WhatsApp is new. Like, let that sink in for a moment. Never mind all the wearables products they have and what they're doing in the AI space. It's actually a really new business model. And you look at that company, I believe the market cap right now is a little under $2 trillion. And think about that for a moment, right? Like, we don't know where the top is on that. What happens when it's a more mature business model? Let's say 5, 10, 15 years from now, right? Where's the dust settle in regards to Meta at that particular time? If we think about the run NVIDIA's been on, I mean, it's a historic run, and they just are seen as a company that's in the forefront of technology and is going to keep the pedal to the metal for the next many years, as long as Jensen's leading that company. So could there be a day Nvidia has a $10 trillion market cap? That could be, right? Maybe the stock has some trouble between now and getting to 10 trillion, right? Maybe 2026 growth rates aren't really there, so a bunch of people sell the stock heavy and stock goes down 30, 40, 50%. And then it has a big bounce back. And let's say the market cap goes down and then to 2 trillion or 1.5 trillion at that time. Then it has a big bounce back where it does this next 10x. And next thing you know, it's a $10 trillion plus market cap, 7 years from now, 10 years from now. Is that a possibility? I wouldn't say it's not. I'd actually say it's more realistic. I would say there's a more realistic possibility that Nvidia is a $10 trillion plus market cap 7-10 years from now than there is of Nvidia being a $1 trillion market cap 7 to 10 years from now, right? Because who's going to magically come out and compete with them in the chip space? Like who? The only company that could even be seen as potential competition is AMD. And outside of that, there's just no one. There's just no one, man. They're just running their own dang race and they're so far ahead of these guys. Amazon. Could Amazon be a $5-10 trillion company 5 years from now, 10 years from now? I can see it being realistic. When you think about how much growth still is in e-commerce, never mind AWS. Oh my gosh. And then their ads business as well and other businesses are going to acquire, because you got to understand Amazon's going to acquire more businesses, likely a lot more businesses over the next 5-10 years, just as they acquired Twitch back in the day, just as they acquired Whole Foods, right? Like they might come out with new game-changing businesses or might just buy them out over time, right? And then expand those into their customer bases. So at the end of the day, it hasn't been a good deal environment, by the way, the past few years with obviously, everything that's kind of going on the government side. But that's going to change. And then if we get folks in these positions that are a little more, let's call it friendly with acquisitions, that opens up the door to a lot of these big tech companies to start doing deals and get their growth rates up in even a better place, right? And Amazon's just one of those many companies. So the moral of the story is be careful betting against these top companies. And if you expect these top companies to not perform very well over the next decade, you're betting against them. It's hard to bet against these companies. Very difficult. They find ways to get the job done. Even Apple, with their, very disappointing lack of innovation since Steve Jobs passed and Johnny Ive left the company, right? Even they're hard to bet against. So the moral of the story is be careful. With that being said, could I see a potential where the stock market doesn't do that great over the next 7 to 10 years? I could actually see that. How does that happen? Well, what could happen is essentially we get a top in the market in the next, let's call it 3 to 6 months. Okay, so we get some sort of topping in the S&P 500 in the next 3 to 6 months. And then slowly but surely, the recession starts to actually come to fruition, let's say in 2026. So you get a topping in the market, let's say, first half 2025, and then real fears start to emerge around recession. But these are like actual founded ones, not just people like talking, right? Like it actually like, oh boy, like unemployment's a problem, something like that, right? And then next thing you know, 2026, 2027, you have a down economy. And let's say you have a multi-years where let's say 26 or 27, that starts the real market downdraft. And so then you have negative stock market performance for let's say a 2 to 3 year span. In that sort of scenario, if over that 2 or 3 year span, you saw the S&P 500 go down 30% plus, right? Well, now we got to climb back. So let's say now it's 2028 and the market is still down from where it was in 2025, right? Because you had a couple years of a downtrending market there. Well, now we got to climb back to get back to where we used to be, right? Of where we were in 2025. So then maybe you get back there in 2029, 2030. And then you start kind of working on some gains from there. All of a sudden, now you're talking about years have ticked by and you essentially, don't have much to show for it. And so that's how you get to a lower, and that's what happened, 2000, if you look at 2000 to essentially 2000 and by the way, in terms of time frame, I don't like looking at it from the next 10 years. I like looking at it from 2021 top at the end of 2021 into 2031. That's a decade that I think returns could be very limited. Because you got to understand, we have reached new highs since the 2021 highs, but not by much. And the Russell still hasn't actually reached to those levels it used to be. So we still haven't even reached there in regards to the Russell. So imagine we get a little higher here And then, eventually we have that big unemployment recession. The market drops a bunch, right? Next thing you know, we're in a much lower place for a couple years there, and then we start climbing back out. That's a potential. So, yeah. Now, with that being said, should you fear that as an investor? Should that scare you away from the market? Absolutely not. Because the bottom line is there's going to be great opportunities for stocks. And you can never predict exactly when a crash is going to happen anyway. So it's kind of pointless trying to, like me, I invest every single week. Every single week. I'm buying stocks in my Patreon portfolio every week. You want to see access to that and see the stocks I'm buying and selling each week, including I just bought stocks on Friday, and every week you can see that, right? I'm buying stocks every week in and week out. I don't care. Crash the market. That's fine. I'll buy stocks for very cheap prices. I have hedges on in my portfolios. If the market goes down considerably, my hedges are going to print money. I'm going to be able to take those massive profits and flush those into stocks at very low prices. So any way the market goes, that's fine with me. Send the market down, I'll make a bunch of money. Send the market up, I'll make a lot more money. Do nothing with the market for a while. That's fine with me as well. Even in a flatlining market where the SP is not doing much, you got to understand there's going to be massive moves in a lot of stocks out there, even in that market. So whichever way you really want to slice it, I'm good. I don't care. Do whatever you want with the market. I'm going to make money. And so that's the name of the game in regards to that. Don't fear that. I would fear that if you're just one of those people that just only buys S&P 500 index funds, right? That's scary. If you're talking about limited returns for the next 10 years, scary in regards to that, because you could be talking about, you're going to have trouble keeping up with inflation. But even in flattish markets, there's some stocks that just outperform tremendously on the upside. And will be up, they'll average an annual return of 20, 30, 40, 50%, even in a downtrend, even in a, let's call it flat market. If it's a big downtrend market, everything gets hit in those sorts of markets, right? Almost everything. Shouldn't say everything, almost everything. But if you're talking even a flat market, there's going to be massive rotations that happen where there's going to be huge sums of money to be made in certain stocks over others, right? And that's where it really comes into being a stock picker and knowing what you're doing in the market, right? So yeah, we'll see what happens in regards to it all. Like I said, as far as me, buy stocks every week. Every week. I don't care. Do whatever you want with the market. I'm going to make money. I'm going to make a lot of money. So that's always my opinion and perspective. And Goldman could be wrong. Maybe the average annual return over the next 10 years is 10%, 15%, 20%. Like, you never know. Like, these companies have already done way better than anybody anticipated. Like, who's to say? Who would you bet against them? It's tough. Next one up here, Tom Lee. Market is still in buy the dip mode.
Tom Lee, who recently raised his target to S&P.
And the one other thing I do think is worth mentioning, we're in a different regime when it comes to market than we've ever been in before. And so I do think you got to be aware that because central banks are so proactive nowadays in terms of worrying about downside risks to the market, they get spooked very easily. I will say it's a lot harder to get those 50% type crashes like we got in the great financial crisis, right? Very hard to get those nowadays because at the end of the day, like they start seeing the market downtrend in any significant way and they're very quick to start cutting rates or change policy or do whatever they have to do. We saw that in Rona, right? Market starts down. I mean, Rona should have been a drop. Rona, the drop in the S&P 500 was, 30 something percent, very quick. But honestly, that drop in the Rona crash should have been bigger. It should have been a 50, 60, 70% drop. Remember, we were talking about closing the economy for potentially 3 years they were talking about. 3 years. They were talking about Great Depression level disaster for the economy. We should have been down 60, 70% in that crash. That should have blown away the great financial crisis. But what happened? The Fed stepped in like crazy and was willing to do whatever it took. And that calmed the market down. And so we only fell like 30-something% in that crash and then start coming back. Boop, 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 boop. That should have been the big one. Like literally that should have like been ridiculous. But it was actually, it was big, but it wasn't like nearly as big as it should have been. Let's put it that way. That's what she said. Alrighty, next one up here. Tom Lee. Market's still in buy the dip mode.
Okay. Tom, good to have you. I loved your note the other day looking at what S&P revenue has done in the face of declining inflation. And your general point is that real revenue has accelerated, and that kind of explains why equities have been so resilient.
That's right, Carl. As you know, many investors and pundits thought as inflation fell, and it it's been cut in half in the last 2 years, that would cause revenue growth not only to hit a wall, but that earnings would stall. But instead, S&P revenue growth is going to be over 5% this quarter. And on a real basis, that's over plus 2%. And that's the strongest. It's really one of the strongest numbers in more than 2 years. And so it is a really high quality earnings season so far. And, close to 80%, or actually more than 80% are beating earnings so far. So it's a good beat season, but it's early.
Right. And how much of it is due to financials? Is any kind of tailwind, although we heard various comments about this, if a Fed tailwind does exist, is it likely to affect other areas of the economy as much as the banks?
Well, in your opening comments, you talked about industrials, and that's something to watch because last week financials reported, and it was, pretty much universally better than expected, and financials are doing really well year to date. But the other group that's very sensitive to the Fed cutting would be industrials, and there's a lot of industrial reports this week. It's about a quarter of the S&P, but I'd say it's so far so good. And again, industrials are doing well in the face of an ISM that's kind of been at rock bottom for 2 years now.
Tom, how much would you ascribe the recent momentum to aspects of the election as that draws nearer, just over 2 weeks away?
I think that's been a dynamic. I mean, I've been fooled by seasonality because I figured from September to Election Day, markets would be very tentative because this is an extremely close race. I mean, this is a coin toss, according to Nate Silver. But something that Stan Druckenmiller said last week might explain a lot, that markets are betting that Republicans could take the Senate, and that actually could ignite animal spirits. So there may be underlying momentum that the Republicans take parts of Congress, and that's why markets are bullish.
Are you at all worried? There were some...
It's funny they keep saying, it's a coin flip race, and I look at the polls and it looks insanely close. Like, coin flip, right? Doesn't feel like it, though. It doesn't feel like it's really that close. Like, I do believe one candidate is significantly ahead of the other. Just based upon what I see out there, talking to people, it feels like it's not really that close, but I don't know. Maybe it is.
Inside of German PPI was down 1.4 year on year, Tom, but there was some ancillary commentary about worries about a reflationary period, largely due to geopolitical events. We mentioned oil coming back a bit today. How worried are you about that?
Well, I think that headline CPI could definitely get affected because oil moves dynamically, and it has an almost immediate effect on headline CPI. And we know transport costs have also spiked recently. Part of it's seasonal, but that affects headline. I think the market's going to be somewhat skeptical that could trigger a sustained reigniting of inflation, but I think the economic data is going to be a little confusing the next couple of months because, the Boeing strike itself is going to affect the jobs report. But I think ultimately the Fed is still on a path towards getting back to neutral. I think that should be the focus. And that means, stocks, which have been strong, are really still a buy the dip market.
Okay. Buy the dip market. Yeah. I think the setup for the short term is still pretty good here. I do get a little suspect because, September and October were supposed to be these bad months for the market, and certainly they have not been, right? November, December expected to be good months for the market. Sometimes just worry about reverse Uno here, and we get an opposite reaction, and for some reason November, December down. But I do think there could be a lot of excitement that comes, specifically if Trump wins. That's a real. If Harris wins, I don't think there will be nearly as much FOMO and excitement in November and December. If Harris wins, I actually think the market will go down November, December. That's my personal belief on that, because I think a lot of people the betting marks are kind of thinking Trump's going to win. And so if Harris wins, I think there's going to be a lot of fear around corporate taxes going up, which could significantly affect the market in a negative way, obviously, if she raises corporate taxes. I think there's going to be a lot of fear about more regulation. I think there's going to be a lot of fear about deal making is going to be really tough if Linda Khan stays over there. So I think there's a lot of I think there'll be a lot more fear if Harris wins, essentially, and I think the market will actually probably go down after election if Harris won for at least a few months there, right, of kind of downtrend. If Trump wins, I think there's going to be a lot of FOMO. I think there's going to be a lot of people super hyped and expecting a booming in the market, and so I think you could see a lot of upward momentum in the market for at least a couple months after the market, after the election. And then after that, we'll see what happens, right? People might get too excited too fast and then realize, oh man, we shouldn't have FOMO'd like crazy, 6 months later or something like that. But the moral of the story is that's kind of what I think is going to happen, depending upon who ends up winning here. Market remains in decent shape after 2-year birthday of bull market.
To continue from here, joining us now, Fidel.
You've got to understand there's a lot of people on the sideline right now waiting for the outcome of the election. And a lot of these sorts of people are the same sort of people that are going to be very excited if Trump wins. And so it's going to be hard to keep those people on the sideline if Trump wins. Like if Trump wins, it's hard for me to see a lot of those people staying on the sideline and be like, oh yeah, I'm still not going to invest in the market. Like, oh really? Like you're still going to stay on the sideline? Okay, that's interesting. That's a hard one for me to see. Market remains in decent shape after 2-year birthday of bull market.
Director of Global Macro, Urian Timmer, thank you for being here. What do you think? What do you make of momentum at this stage, especially given we are, a few months from the end of the year where those trades do tend to kind of get that second thought and can sometimes reverse?
Well, seasonally, good morning, by the way, seasonally we are now in the stronger part of the annual cycle, right? So the weakest part, as we all know, is May till the middle of October, and then the strongest part is mid-October to April. At the same point, we're in the fourth year of a presidential cycle, which tends to be one of the better years. So we do have some momentum there. And the good news is that the market has been broadening, and it has not come at the expense of the overall index like we saw in July, right? The Mag 7 was rotated out of, and it actually knocked the indices down because those stocks are so big. Now we're seeing a kind of a gentler broadening where 80% of the stocks in the S&P are above their 200-day moving average, meaning they're in long-term uptrends. The S&P 500 equal weighted index is making new highs on a daily or weekly basis with good momentum. So we are seeing a really nice bull market, nicer than what we've seen in the past in terms of participation. And remember, the market is expensive, of course, on a cap-weighted basis, but on an equal-weighted basis, the PE is only about 19 times earnings, which is not cheap, but it's not nosebleed levels either. So I think overall the market remains in decent shape. We just passed the 2-year birthday for the bull market, up 68% in 24 months. The median bull market is good for 90% over 30 months. So by that measure, we still seem to be incomplete from that perspective.
Yes. Happy birthday, bull market. I'm curious if kind of as you lay this all out, what that means from a stock picking standpoint. You have 112 S&P 500 companies reporting this week. So far, earnings season has been off to a very strong start. But from here, do you expect investors to be a little picky and choosy, or do you think that there is kind of this rising tide sentiment aspect to this that should bode well for the remainder of earnings season?
I think right now it is the rising tide. I call it the everything else trade, right? So the first phase of this bull market was somewhat narrow, not nearly as narrow as it was in the late 90s when the index, the S&P, would go up, but most stocks actually went down. I mean, mathematically, that's pretty hard to accomplish. During this bull market, most stocks have been going up, just far less than the Magnificent Seven. And now we have this broadening, and, with rates now coming down, at least the Fed now in a modest rate cutting cycle, and earnings growth, as you mentioned, broadening and showing some good momentum, it's an opportunity for everything else to work, whether it's financials or interest rate sensitives. And it's interesting, second quarter earnings season, of course, is underway. I do detect, though, that even though the earnings growth is coming through, the acceleration of growth seems to have ended. So we are reaching a more mature phase of the earnings cycle, which is not to say that earnings are going to come down. It's just that they're growing, but they're no longer accelerating higher.
100%.
Which makes sense.
That's a more mature bull market, right? That's a more mature bull market is what we're in now at this point in time, which means the gains in overall indexes, you shouldn't expect them to be nearly as strong. Let's say you're even bullish, you're expecting the market to uptrend over the next 2 years, which, is very possible, right? Okay. Don't expect the sort of gains in the indexes, as in the Qs and the S&P 500 over this next 2-year span as the last 2-year span, right? That first couple years coming out of a bear market, which we certainly had in 2022, right? Very exciting gains. That's where the most money's to be made. You can still make good amounts of money in a more mature bull market, but the places you're going to make the big money, not the same places. The places you made the big money the last 2 years are where? Big tech, Meta, Nvidia. Like, look at where those stock prices were at 2 years ago. Look where Meta was at, where Nvidia was at, where Apple was at, Microsoft. Just go through the whole list of companies, Amazon, blah, blah, blah. That's where the big money's been made over the last 2 years. Like, phenomenal returns, right? Palantir, oh my gosh. Then you could say, okay, what about other companies? There's been a lot of laggers, a lot of lagging stocks over the last 2 years, right? That haven't done a dang thing. And it's a long list of those stocks that haven't gone really anywhere the last 2 years. Those are actually going to be the opportunities over this next 2 years. You're going to see a big catch up, in my opinion, over this next 1 to 2 years in those stocks. And so that's where the big money's going to actually be made over this next year or two, is in a lot of these smaller cap stocks, like the mid cap stocks, a lot of these value and dividend names that have honestly sucked for really the past 2 years. Like, you look at them and it's like, Jesus, stock's flat in the last 2 years with the S&P 500 up this much, or it's downtrended. Those ones is actually where the opportunity is to make big money over this next year or two. Once those ones play catch up, I think you'll probably be at the end of the bull market. I think that's going to be probably when the show wraps up, is once you get not only the big dogs to kind of top there, but then you can get all those ones to top. And then I think you start to get into a little bit of trouble in regards to trying to get gains from the market from there. And then we probably go into the next bear market, right? Which lasts, anywhere from 1 to 3 years. And that will be that. A lot of money to be made on the downside in that, right? And then the amount of money to be made coming out of that is going to be astronomical. But remember, that first couple years coming out of that bear market, that's where the biggest money is going to be made. And, just got to kind of keep that in mind. And a lot of times it's the sort of companies that are seen as stable, but also have good growth, right? Which would have been the categories of like the Nvidias and the Metas and all those sorts of companies. Those are seen as stable companies, but they also have very, very strong growth. And so therefore, that's where people pile into.
He's inflected about a year ago.
All right. Yuri, and I love your point about the impact of elections on markets. You do say there is an effect in, say, the first couple of years, but over a 4-year cycle, the market's so large, it's kind of hard to find.
Yeah, absolutely. So over the 2 years following an election, obviously, whether it's a sweep or a divided Congress, those things do matter, of course. But we have this brilliant thing in the U.S. election system called the midterm elections, and they tend to course correct outcomes that might be considered, extreme or lopsided. So the checks and balances works nicely. And if you wait 4 years, so over an entire cycle, it makes virtually no difference whether it was a Republican or a Democrat or who controlled the House, who controls the Senate. The returns are basically identical. And as you point out, the U.S. stock market's $50 trillion. The U.S. economy is almost $30 trillion. The global economy is $105 trillion. These are really big numbers, and it takes a lot to move that ship.
Alrighty, next one up here. Microsoft takes aim at Salesforce with new autonomous AI agents.
Today, launching 10 autonomous agents to help businesses with things like sales, customer service, or accounting. And that'll be available for public preview beginning in December. Our Deirdre Bosa has more on how this could be the next leg in the AI race on today's Tech Check. Hey, Dee.
Hey, good morning, Carl. So AI agents, yes, shaping up as the next leg, battleground, buzzword, and enterprise AI. Microsoft's announcement, it comes just days ahead of the general availability of Salesforce's competing agent force, and it pits these two companies against each other since they're essentially doing the same thing with these tools, which is creating virtual employees or supercharged customer service chatbots that can automate tasks. Now, they're both hoping as well that agents can better sell their tools, and they're promising that it'll deliver deliver better results as well. As our Steve Kovac has reported, Copilot has underwhelmed customers. But the big question now is whether agents will be able to live up to expectations. And those expectations are certainly building, led by who other than Salesforce CEO Mark Benioff, the great hype man himself. Leading up to this release from Microsoft, Benioff has been taking every chance he gets to slam Microsoft's current Gen AI product, Copilot.
Copilot experience for so many customers has become the Clippy experience. What I mean by that is they're just not getting the value that they want. We just don't see Copilot as that key step for our future. In some ways, they kind of looked at Copilot as the new Microsoft Clippy. And I get that.
And again, on Friday, posting to X, Clippy, Copilot rather, is more like Clippy 2.0. He really does not like Clippy. And for those that might not remember, this was this paperclip-shaped assistant in Microsoft Office from the late 90s and early 2000s that gained a reputation for being intrusive and annoying and not particularly useful. Benioff, meanwhile, mentioned the word agent 65 times on his last earnings call. The year-ago quarter, just 5 times. Microsoft, and I found this interesting, guys, was actually talking about agents a year ago as well, but hasn't been pushing it as much on earnings call. Today's announcement, that is a major acknowledgement that it wants to be seen as this new, more innovative agent space. NVIDIA, meanwhile...
So... yeah, in terms of Benioff, by the way, I think it's important. Anybody that ever wants to get into sales, definitely watch Mark Benioff over the years and really pay attention to his interviews, pay attention to his presentations. I think he's one of the best salesmen in history. That you could ever pay attention to. I think that man's phenomenal, right? And so, and it's interesting because in sales, a lot of times they say don't mention your competitors, but he's certainly not afraid. And I would never go against Benioff. Like whatever he does, genius. Okay, so if Benioff says you can talk about your competition's products, I say, damn, okay, you can talk about your competition's product.
Maker and Gen AI has also been talking up agents more, right? Both on earnings calls and outside of them. On the Gerstner Gurley podcast about a week ago, Jensen Huang envisioned NVIDIA as a 50,000 employee company with 100 million AI agents. So keep an eye out this upcoming earnings season. The mentions of agents could rise dramatically, guys. A year ago, maybe it was all about chatbots, but this year it's going to be agents on the earnings calls.
Wow.
Well, I was looking at Goldman over the weekend, boosted their Microsoft CapEx forecast for 2027 to $82 billion, D. They are spending on CapEx more than any other hyperscaler.
It's a great point, and that raises the stakes, right? That is why they're putting out new products and hoping that there's going to be better ROI for their customers, because as we've sort of seen reported, Copilot hasn't necessarily lived up to the expectations, but an agent is a different product. It can automate tasks, so it should supercharge productivity, and hopefully, certainly, Salesforce and Microsoft and others in the enterprise space are hoping that companies start to see better efficiency, better top-line growth, better earnings power, and agents may be the one to unlock that, but we'll see. It could also be overhyped.
We were just figuring out chatbots. Now we got to move on to this. Dee, great story. Thank you, Deirdre Bosa.
Thank you.
Yeah, 100%. I was looking at Microsoft versus Salesforce kind of valuation metrics and things like that here on 1000X, comparing those companies, right? So as far as forward P goes, Microsoft 31, Salesforce expected to be 27, almost 28. 2-year forward P, Microsoft's around 28 roughly, but then Salesforce jumps to 26 here. Now, as far as next year expected earnings per share growth, about 17% for Microsoft, which is a very nice number. 50% plus here for Salesforce. So analysts are very bullish about earnings per share growth with Salesforce next year. Revenue growth-wise, a little higher for Microsoft than Salesforce. That could be just maybe the crazy amount of spending that Microsoft's doing here. So, and then as far as net margins, Salesforce certainly has a long way to go to get back, but maybe that's some of the profit recovery here, right? Gross margins actually ahead for Salesforce versus Microsoft. So, I mean, if I had to buy one, I might actually be a little more inclined to buy Salesforce over Microsoft. I mean, I don't love either stock, but I do like both. That's what I'll say about those sorts of stocks, right? Alrighty, next one up here. Kramer stopped trading on RH.
things to look at, which is available to anyone watching the show. Just sign up. And there was a note from Wedbush today that even though you think it may be late, RH, Restoration Hardware, has been upgraded. I know that Gary Friedman preferred to call it RH, the CEO. But I've got to tell you, this thing may just be beginning. The huge number of shares bought back by Gary, and I think that the business is on fire. He told me personally that they have now inflected. He was waiting to tell me until they had inflected. This thing is a rocket ship from 240 to 360. Maybe if it comes back, you buy some, but you can buy some right now.
Wedbush targets 430.
Yeah,
they'd say that might even work, even if the macro doesn't cooperate.
True. I mean, and his whole strategy, Gary's strategy of putting these beautiful galleries all over the world is really resonating. And look, lower rates are going to help. He got hurt by the worst. There was a housing turnover recession that hurt him. But I urge people to think about this as an investment. I think it's very, very good.
So tonight, Banco Santander.
Ana Botín is the largest bank in Europe.
Yeah, I don't love RH. I do think they set up a little bit better if we can get the high-end housing market going. But I don't know. The high-end housing market still seems like it's in a troubled place. I'll be honest with you guys. So maybe it eventually gets rolling. But yeah, I don't like what they've done with the balance sheet at RH either. So that kind of troubles me. But great company, though. I really like it. So, alrighty, guys. Appreciate you joining me as always. Thanks so much for being here. If you're looking to access my Patreon, that's going to be pinned comment down there to see the stocks I'm buying and selling each week. Plus, there's a Discord chat for that as well. I also have one that has a Become a Master Stock Market course attached to it. Prices are about to go up here very soon. 30% for people that don't join here over the next few days. So do be aware of that, okay? Alrighty, much love and have a great day.